Ben ritrovati a tutti, oggi vi parleremo del FAM Eurobond. È una strategia obbligazionaria che ha come obiettivo quello di battere l'indice Bloomberg Euro Aggregate. Investe quindi in obbligazioni sia governative che societarie denominate in euro, con un merito creditizio molto elevato. Minimo il 70% del portafoglio deve essere investito in obbligazioni investment grade. Adesso ne parleremo con Jonathan Snow, Investment Director del nostro team Fixed Income.
European bonds look like very attractive investments right now. Although fixed income markets have been volatile over recent weeks, fundamentally we still think that a gentle economic slowdown or soft landing is the scenario that's most likely to play out over the next few months. We acknowledge there are some risks to that view. Most recently there's been better data on economic activity, suggesting that in Europe and elsewhere, growth could get stronger from here. And as a result, central banks have been pushing back on the market's expectations for lower rates. The broad message from the ECB to investors has been, rates may have peaked, but don't get too excited about rate cuts happening soon. And that's meant government bond markets have been a bit weaker so far in 2024. But for now, our central fixed income outlook is still for a global economy which is not too hot and not too cold, with slow but steady growth and gently declining inflation. And that's generally a very supportive environment for both government and corporate bonds. On top of that, the level of yields available to investors is as good as it's been for more than a decade. Core European sovereign yields haven't been this high since 2011, and European investment-grade corporate bonds are still offering a yield of around 4%. So how is the portfolio positioned at the moment? Well, in terms of duration or overall exposure to the bond market, given the supportive environment, you might think we'd be overweight. But we need to be careful here. In practice, the risk of yields going up if growth strengthens, as we've seen over the last few weeks, makes us a little more cautious on outright duration. So we prefer to take more specific positions in different maturities within the market. These are more flexible trades than relying on headline duration alone. The portfolio is also overweight corporate bonds, but we should note that these have performed extremely well in the last few months, and while still worth holding for yield, they are looking expensive, which means we've been focusing on those areas of the European credit market where our research has highlighted high-quality bonds which also offer relatively high yields compared to their history. One example is covered bonds issued by European banks, which are backed by ring-fenced assets and therefore make very secure investments. These provide some great opportunities for the portfolio. So in summary, given a favourable environment for fixed income, slow growth, stable inflation, attractive yields, the portfolio has a neutral duration overall, is making great use of more nuanced trades in different areas of the market, and maintains an overweight in credit, enhanced with focused investments in particular sectors. These positions have helped the fund perform strongly in 2023 and into 2024, and we're confident it will continue to do so as we move further through the year.